Okay, the purpose of this video is to walk through the method that I've created in very simple terms to help a professional accountant understand why this method is useful. Okay, that's what I'm trying to do here. So I've been through a lot of this in other videos under process control, and there's another video on this method that's in a little bit more detail. But the primary thing that I want to focus on is the question, what is the aim of the system? Okay, the aim must be stated and it must be managed. Okay, so just keep that in the back of your mind. All these other things are very important, and I've gone through these. And I'm going to go through a couple of them in a little bit more detail, but keep that in mind. So first, the business requirement. Systems need to work. Prudence dictates that using information from an XBRL-based financial report should not be a guessing game. I contend that a safe, reliable, predictable, automated reuse of reported financial information is preferable. Okay, so that's the business requirement of what we're trying to achieve here. If this stuff isn't going to work, why do it? So if it works correctly, you create a virtuous cycle. So you define terms, associations, structures, rules, and models. You create facts in reports using those terms, associations, structures, rules, and models. You verify that the reports were created correctly against the definition. You extract information from the reports, and if there are mistakes, if there's confusion about a term, fix the term. If there's error in the associations, fix the association. If there's a missing structure, add the missing structure. If there's a missing rule, add the missing rule or change the rule that might be incorrect. And then you have better definitions of terms, association, structures, rules, and models. And basically, you get this working and life is good. So consider this. This is a comparison of about 91 insurance companies. I did this several years ago. It's hard to see because there's 91 companies. You can go to this link and view this better. So here's a subset of this. So ask yourself a question. Here, all these guys have got, most of these guys have got green check marks, but you got a couple that have got red. What's wrong? What is going on with the ones that have red check marks contrast to the ones that have green? It's not a problem. You just go look at the report and you can see what's going on. And if there's a problem with the report, you fix the report. If there's a problem with the rule, you fix the rule. If there's a problem with the software, you fix the software. And then once you do that, everything works. And then you have all 91 companies always have comparisons that actually work. That's the goal of what we're trying to do with this digital financial reporting. So we create a method that achieves that goal. So I've distilled down all the errors that I've found in XBRL-based reports can fit into these categories. I'm going to explain each of these categories. Okay. This method is how you control the process. If all these are green, then life is good. And if they're not, you fix whatever's making it not be green. Okay? So syntax. Syntax is not a problem. This is 100% automatable today XBRL International publishes a conformance suite. Software is required to pass that test to be, certified properly functioning XBRL processors. And these are all the details that you see. And we don't need to dwell on this because 99.9% of all reports now pass all these rules for syntax. It wasn't the case back in 2009 when this started, but now syntax is not a problem. So I'm not going to dwell on syntax. Model structure rules. You have three primary types of relations in XBRL. The definition relations and the calculation relations are enforced by XBRL International Conformance Suite rules, but the presentation relations are not. So I wrote some rules that enforce this matrix that you see in the upper left right-hand corner that give you the allowed XBRL presentation relations so that you can create your models correctly. And I'm not going to dwell on this. This is, number one, most people are doing this already. There's some that are not. But this is really pretty straightforward, and accountants are not interested in this. Software should just do this correctly, and the accountants shouldn't have to be dealing with this. This is not rocket science. Now we're getting into ones that accountants do have to kind of deal with. So here you see an example of a type-subtype relation error. The U.S. GAAP taxonomy defines the concept revenues right here. It defines the concept sales revenues net, and it shows the relationship between those two concepts. This is a type, and this is a subtype of that type. What happened here is that the reporting entity used the concept revenues as a child of sales revenues net. So they basically reversed this, which is not okay. So you need to have and enforce the type subtype relation rules, and you don't have these kinds of errors. People call these different things, general special relations, or narrower wider relations. Either way, you have to control this. So companies can move stuff around. So here you see company A use these two line items as a child of financing activities, and here they use them as children of investing activities. So you don't want that. You don't want people to use these line items incorrectly. You want them to use them correctly. That's what the type-subtype relation rules control. Here's another example. When you create an extension concept, so here you have land, buildings, equipment, and these are the same. But here you have land and buildings, computer equipment, and manufacturing equipment. So land and buildings was combined. Equipment was broken out. How do you control this in a report? These are all the same. It's just that the details are different. That needs to be controlled. These are continuity cross-checks. So here you have continuity cross-checks are just high-level relationships, and they need to be consistent with expectation. So one such rule is that net income loss plus or minus other comprehensive income equals comprehensive income. And here you see that that is correct. Okay? Here, it's not correct. Here, you have this relation, and the reporting entity has put in a positive value, but it should have been a negative value. You can see that because if you take this number and divide it by 2, an old accounting trick, you see that it's off exactly double the amount of this concept. So here this error is being caught, and similar errors would be caught in whatever high-level relations that are represented. So that's another example of a continuity cross-check that you need to make sure is correct. This is more complicated, but fundamentally it boils down to the fact that an economic entity used the concept assets non-current, and they should have used the concept non-current assets. So I'm not going to go into detail, but basically they used the concept in a disclosure that belongs on the balance sheet, and they didn't explicitly report it on the balance sheet, so there's a contradiction, and these rules caught this. I'm not going to explain this in any more detail. Here you see a entity that switched concepts. They should have used this concept here and this concept here, but they made a mistake and reversed them, and that's why this is an error. So these are all the fundamental accounting concept relations errors, and I have hundreds of documented examples of these, hundreds, literally. Disclosure mechanics rules. So here on the left, you see the inventory disclosure, and on the right, you see the rules that describe what this needs to look like. This needs to be this concept or one of these alternative concepts. And there's other rules here I'm not going to go into, but if you, I'll just leave it at that. The disclosure mechanics rules check to make sure that the disclosures are created correctly. Here you see the results of checking. I think it's 121 different disclosures for the 194 different disclosures that Microsoft reports, or sets of disclosures that Microsoft reports in its report. So there's lots of these different disclosure mechanics rules that need to be checked, and you have to have a rule for each one. And if you do, you can check all this stuff, and if something is wrong, it sticks out like a sore thumb. If you don't create a rule, you could have an error, and you don't even know that it's an error because it hasn't been detected, because you don't have machine readable rules to check. So here's another example of what that looks like. Here's what the rules look like. There's the line of reasoning for finding the disclosure, this specific disclosure. I'm not going to go into that. So reporting checklist rules. There are certain disclosures that are always required to be provided. For example, the balance sheet, income statement, comprehensive income, cash flow statement, statement of changes in equity, basis of reporting, nature of operations. They're all required disclosures. So if you have a rule that states that, you can discover if required items are not reported, or some items are required if a specific line item is reported. So for example, if the line item inventory is reported, then you would expect that there be an inventory disclosure. So, and an inventory policy, etc. So that's what the reporting checklist rules do. So if everything is okay, then this dashboard tells you that it's all green and the report is correct. If you don't have the rules and you don't check the report, you don't know whether it's right or wrong. Just ignoring errors does not mean that you created the report correctly. So here, this is the XBRL Cloud Edgar dashboard. It shows you the errors that exist in both US GAAP and IFRS filings to the SEC. So I'm not going to explain this, but it should all be green. If everything was correct, and this was a virtuous cycle, errors would be detected before the reports are created. They'd be corrected, and then when they're submitted, they would all be green. And here you only have 3 out of, I don't know, 21 that are green. So all these first 1, 2, 3, 4, 5, 6 items are automatable, but the to-do list, this, is 100% manual. Basically, that's the stuff that a machine cannot check because either A, you didn't create a rule, or B, it's impossible to create a rule, and therefore you can't create a rule, and therefore it has to be checked manually. So it's preferable that things are checked using automated processes, because what that does is it makes the amount that you have to check manually go down. And we all know that humans make mistakes, so an automatable process is preferable where it can be automated. And all of these categories, I'm showing you that they can be automated. So here are 2 implementations that are consistent that use this method. XBRL Cloud, and which is a commercial software application, and Pesserac, which is a working proof of concept. Both use these this method. These results, they're for Microsoft. We checked 194 fact sets or blocks, which is an organization of 2,234 facts in 121 disclosures, and these are the results. I'm not going to go into the detail of these, but it doesn't just work for Microsoft. It also works for all of these companies: Amazon, Apple, Salesforce, Facebook, and Alphabet, which used to be called Google. And you can look at all this. This is online. You can examine these results. And so here you see a comparison of every XBRL-based report, the fundamental accounting concepts that Apple submitted, and there's not one mistake, not one. Here's Microsoft. They made 2 mistakes. I'm not going to explain what the mistakes were, but they are confirmed mistakes. Here's Salesforce, no mistakes. There's Amazon, no mistakes. There's Facebook, no mistakes. There's Alphabet, Google, no mistakes. There's AT&T, lots of mistakes. There's Verizon, lots of mistakes. This is all measurable. There's a comparison of, 20 different balance sheets. There's a comparison of income statements, all correct. And I'm going to call that good.